Good morning, Lori. Give me just a few seconds to let other people sign on, and then I will begin. Hi, Freddie. Hi, Jay. Hello, Andre and Andrew. Okay, respecting people's schedules, I'm going to begin and others can join as the time permits. Good afternoon. Welcome to today's webinar on cash flow management for small business owners. This webinar is being presented on behalf of all of the chapters in the Massachusetts and Rhode Island District of SCORE. My name is Jim Danhauser. I'm a volunteer mentor with the SCORE chapter located on Cape Cod and the islands. And I am going to actually be leading today's discussion throughout the program, but I wanted just to start by covering a few introductory items. For those of you who are not already familiar with SCORE, we are a fully volunteer nonprofit organization and a resource partner of the U.S. Small Business Administration. SCORE's mission is to foster vibrant small business communities through mentoring and education. We've been pursuing this work since our founding some 60 years ago by educational opportunities like this webinar and by providing mentoring assistance to people who are in business or who are thinking about starting a business. Each chapter in the Massachusetts-Rhode Island District has a significant number of volunteer mentors and subject matter experts, people with a broad array of differing business experience and expertise, all of whom stand ready to provide assistance to you in connection with your business efforts. And we can connect you with volunteers throughout the country. So we're pretty sure that we can get you connected with someone who has relevant experience for your business activities and can give you mentoring help. Importantly, all of that mentoring is completely free and absolutely confidential. So how would you take advantage of that mentoring service if you'd like to do so? Well, you can go to the SCORE National website, www.score.org. Go to the chapter, the website of your local chapter. The ones in the Massachusetts, Rhode Island district are listed here. And in either case, click on the Find a Mentor tab and the Request a Mentor in the drop-down menu, and you'll get started. It's very easy, completely free, absolutely confidential, and can be of real value to you. A couple of just quick rules for today. I'd ask that you use the Zoom Q&A feature to ask questions. I'm going to try to address those questions as they come in during the course of the discussion, but it's much easier for me to do that if, in fact, I only have to look at one feature as opposed to toggling back and forth. So please don't put it in the chat and don't raise your hand to try to speak. Try to put your questions, if you have them, in the Q&A, and I'll answer them as we go along. I'm going to apologize in advance. I'm fighting the onset of my first cold for the fall, so I might get a little scratchy, but forgive me if I do, and I need to stop once in a while to take a sip of water. In terms of the webinar, it is being recorded. We'll send a link to that recording out to everybody who registered. You'll get that once that recording is available in the next day or two. So with that, let's get started. What are we going to cover? Well, I'm going to talk about a very brief overview of financial statements. I'll touch also briefly on startup costs and budgeting, but I'll spend most of my time talking about cash flow statements and, most importantly, how you can use a cash flow forecast to manage your liquidity and stay on top of your business needs. So why do you have a financial reporting system? Well, you have it so that you can gather accurate and complete information on a timely basis. Why? Because that's where you need to be in order to make better, smarter decisions about your business. Should I hire more people? Should I look to grow? Should I make an investment? None of those decisions can be made smartly unless you have an accurate handle on the financial condition of your business. The key is accuracy and completeness. If your information isn't complete, if your information isn't accurate, you may end up making bad decisions about what you should do. And of course, you should always avoid garbage in, garbage out. So what are the basic financial statements? The first is an income statement, which is also called a P&L. What does that do? It'll show you the results of your business for a defined period of time. You may prepare it on a cash basis. You may prepare it on an accrual basis. And I'm not going to talk extensively about the differences between those two because that's a technical accounting question. But the income statement speaks as of a period of time, typically a month, a quarter, or a year. The balance sheet, on the other hand, is a snapshot of the financial position of your business as of a specific date, typically the last day of the month, last day of the quarter, or the last day of the year. It'll show the assets that the business owns. It'll show the liabilities and payables that it owes, and the excess of the former over the latter is your shareholder equity. A cash flow statement, like the income statement, speaks of a period of time. It covers where the business's cash has come from and where it has gone over that period. And it is the most important financial statement for most small businesses. There's another very important financial document, which is your budget or forecast. What that does, it reflects the performance you expect for your business over the next period of time. And that is, in fact, the most important financial document that you should be working with in a small business. Startups. Every startup needs to prepare a cash flow budget. What should it do? It should show the cost of development, planning, getting ready to operate, and costs that are going to need to be incurred to reach break even. Break even is that lovely point where your revenues are equal to your expenses. You should always include a contingency because in the history of the business world, no startup has ever gone exactly as the people thought it was going to go when they set out to do it. So there are a lot of other webinars that speak specifically to startups. This is all I'm going to talk about in that context. If you're interested, you can go on the SCORE website, www.score.org, and use the search feature to find webinars that will specifically talk about startups that will be helpful to you as you prepare to get going. Cash flow statement. What is cash flow? Quite simply, it's all the cash that comes in and all the cash that goes out from your business from all sources. That includes revenues that you collect. It includes assets that you sell. It includes all the costs, whether it's operating costs, costs of your debt, dividends, everything. All cash that comes in and all cash that goes out is captured in your cash flow statement. It looks at those inflows and outflows over a specific period of time. And the most important thing I will tell you is that you need to develop the discipline of looking at that cash flow statement frequently. You'd be surprised to know that a business can operate at a profit, but it can still lose cash. I have some questions coming in I'm going to take a look at. Okay, they were just greetings. Hello to everybody. I had to keep the screen in this size for the moment because I'm going to be sharing other documents that is easier to share when I am in this size. And when I'm finished with that, I will expand it so that it's a larger screen. Okay, can everybody see that? This is a 12-month cash flow. It is a template available on the SCORE website. You can go to www.score.org, go to templates and resources, and you can access this. And the beauty of it is that it will fill out the form. Once you enter the information, the formulas work automatically. It captures all the cash in and all the cash out. And that's the kind of a thing that will be very beneficial to you. How do you prepare a cash flow statement? Well, your accounting system can generate one easily, and that's the place that I would go to look at. Whether it's QuickBooks or any of the other systems, you can generate a cash flow statement quite easily just by pressing a button. I showed you just a moment ago the score.org template. There's also a very good blog that is quite comprehensive and easy to follow. It's listed there. It's in Fundera. It's how to calculate cash flow, and it's very useful tool for you to access in the context of trying to figure out how you prepare a cash flow statement to the extent you want to get into the details. If you have an accounting system, I would suggest that you be very comfortable just having the accounting system generate the cash flow statement for you. I'm going to show you a typical cash flow statement just so you can get a sense of what they would look like. This covers the full year of 2023. You'll always see in a cash flow statement the cash at the beginning of the year or the beginning of the period. Then you will pick up cash flow from operating activities, whether that's receipts from customers, wages paid, etc. There's a separate block for cash flow from investing activities, which will pick up anything you purchase by way of capital assets or anything you sell. And there is cash flow from financing activities, which would be bank borrowings, bank repayments. The sum of those three sections will give you your total cash flow for the period, and then you will have your cash at the end of the year or the end of the period, which is the beginning cash balance as adjusted by the cash adjustments through those three steps. Again, I would not worry extensively about the particulars of how you prepare a cash flow statement. If you have questions about that, I'd be happy to answer them as we go along. Okay, you've heard it. Hang on for just a second. I'm going to look at a few questions that are coming in. I'm sorry, I am flying solo, so I need to do that periodically. Okay, you've heard, and I assume everybody can now see my PowerPoint display. If that is not the case, please so indicate in the chat. You've heard 100,000 times probably that cash is king. There's a reason that that's a truism. It's because it is true. Most failures for small businesses can be traced to cash flow problems. Running out of cash is death for a small business. I used to tell people who worked for me that we could survive anything so long as we did not run out of cash. So you have to stay on top of your cash resources and your current and future cash needs to avoid a liquidity crunch. There are some simple things that you can do that will help you. It's an absolute must that you keep a separate bank account for your business. Run all of the revenues and expenses of your business through that account and run no personal items through that account. Keep it completely separate. It's the easiest way that you can monitor cash. You can simply look at the bank account. It also makes eventual tax return preparation easier and helps to ensure that proper deductions are taken. I can tell you, I've had a number of clients during my mentoring time that did not keep a separate bank account for the business. And trying to reconstruct what actually was going on in the business and stripping out all of the personal things was a nightmare. You cannot know exactly what the status of your business is unless you keep a separate bank account. I would also recommend that you keep a separate credit card for your business if possible. Use that credit card only for business expenses, and always make sure that you don't do it for anything personal. Now, people will say, well, credit cards cost money, and that's true. I could use my debit card, and that's true. But the thing about a credit card is that you may find times in your business where you don't have sufficient cash in your account to make an inventory purchase, for example. Having a credit card will enable you to have the ability to acquire that inventory. It may be the only source of credit available to you. Now, be careful. Credit card debt is very expensive. It is the most expensive debt that is around. So you need to make sure that if you use a credit card for your business, that you pay it on time. You should also look at your cash flow statement at least monthly. You should keep a good cash flow forecast for the next 12 months and keep it updated, because circumstances change and you need to take account of those changes to make sure you stay on top of your liquidity needs. Maintain good accounts receivable and collection practices, and I'll talk some about that. And avoid overdoing it on supplies, inventories, and equipment. I know everybody always wants to make sure they have a full line of everything they could possibly need, but that eats up cash. So make sure that you buy what you need when you need it, and don't overdo it. I want you to make sure that you prepare a cash flow forecast each year as part of your budgeting process. Now, I know that you can't be certain of exactly when cash items are going to hit, either in or out, but do your best to plan based upon what has happened in the past, because you need to know what your liquidity requirements are going to be. You should update the forecast every month, or more frequently if need be, to reflect what actually happened and to anticipate what's going to occur over the immediate term and over the next 12 months. And if you start seeing that cash is getting very tight, you need to look carefully at the next week and the next month to see if there are immediate issues that you need to attend to. Because things change. Just think back a few years ago to the onset of the COVID pandemic, and you'll realize how rapidly and significantly things can change. And it's not just major items like that. It could be new competition. It could be new developments. You could have lost customers. You need to reflect the impact of those changes. You don't just make a forecast and have it sit on the shelf and look back at it after the year is over. You need to look at it, reflect the impact of changes, because you can't make smart decisions about your business unless you can see what your cash situation is and what it's going to be over the next 12 months. And this is particularly important for an economy like Cape Cod and the islands. You have to bear the seasonality of many businesses in mind. Everybody can feel great in June, July, and August. But at least so far, in my experience, every year has also had a January and a February. So make sure that you're taking account of the seasonality of your business when you are thinking about what steps you should take. And now I am going to share a cash flow forecast. Let me know if everybody can see that in the chat. I'm going to assume that you can see this forecast, unless somebody tells me otherwise. Okay, cannot see it. Okay. How about now? Okay. Okay, this is the reason I want to pause on this is actually to show you the benefit of having a cash flow forecast in your business. See, this company started in January with a cash balance of $20,000. It ended the year with $11,000 in cash. So you'd say, oh, okay, it was small. And the numbers are not significant in and of themselves, but they are significant as an example. Brought in $700,000, spent $709,000, so it burned $9,000 in cash for the year, but it still had a positive balance. But look what happened here in March. Suddenly it was $11,000 in the hole. Now remember, the numbers themselves are not significant. You may say they're small, but they're illustrative of an example. How did it get there? It was only losing $9,000 for the year, but it's already burned through $31,000. Well, it spent $40,000 buying inventory, presumably for getting ready to start the season. If they had known that doing that would have put them $11,000 in the hole, what would they have done? Well, they might have slowed down that inventory purchase by a couple of months. They might have tried to buy some of the inventory on credit, because oftentimes your suppliers may be the best source of credit for you in your small business. They might have purchased some of that with a credit card. But they would have done none of that if they didn't have a cash flow forecast that showed them that they were going to be $11,000 in the hole come March. Again, small numbers, not the point of the magnitude of the issue. It is the reality of the issue, and you can face that in your business unless you have a forecast. So then they start getting into the season and they're selling, but lo and behold, come June, they're back down another $4,000 in the hole. Again, $4,500, not a big number, but still, it's in the hole. And if they haven't done anything about it, they're in trouble. How did that happen? Well, they bought a piece of equipment for $20,000. If they knew that that was going to put them in the hole, and that's obviously when the cash was paid, it is not necessarily when the equipment was ordered, they would have not necessarily done that. Again, they might have bought it on credit. They might have extended the time frame to buy it to when the cash was a little bit richer. The point is very simple. If you don't have a cash flow forecast, you're going to be making decisions about your business that could potentially get you in trouble. And that is something that you need to avoid. Okay, hopefully now people can see the full screen. And I've raised the size so that it's easier for people to see. And yes, the answer to your question is that the slides will be shared because I'll be sending the link to the recording and you'll be able to see the slides as you go through that recording. Again, if I could ask that people put questions into the Q&A, it's simply easier for me to follow the one screen as opposed to toggling back and forth. Accounts receivable. It's a big issue for many small businesses. And in my mentoring experiences, it causes as many liquidity problems as almost anything else. So I want you to try to develop and maintain good practices for your accounts receivable. Now, if you're in a business that doesn't generate receivables, maybe it's a retail business, maybe it's a service business where you get paid upon the delivery of the service by credit card, congratulations, you'll avoid this entire issue, which is a very valuable thing to avoid. But assuming that you are in a business where you do generate receivables, these practices are very important. Timely billing is the most important. Get the bills out as soon as the work is done and clearly state what's been done, what's owed, and when the payment is due. I've had many clients who didn't do this and receivables built up. And remember, receivables are your cash and you need that cash to run your business. There's really very little excuse any longer to not do this on an effective basis. Virtually every accounting system has an invoicing tool that will enable you to get the invoices out or have somebody get them out for you. that will be most efficient and will integrate with your accounting system so that you'll be able to check and see what receivables have not been paid. We would advise that you send the bills out to the extent you are sending them out. Send them both by regular mail as well as by email. You should make clear how the check should be made out and where they should be sent. And if you're going to accept online payment by credit or debit card, make sure you give clear instructions on how that gets done. And I would suggest that you get to know who at your customer is actually making the payments, because you don't want to chase down everybody. Know who it is, and you can communicate with them regularly. You should monitor the collection processes. Again, you'll have an accounting system that should make it very easy to do that. And if you don't, then come up with some other system, whether it's an Excel spreadsheet, pen and pencil, on paper, whatever. But make sure that you're keeping track of those receivables and that you see if payments are being late, and reach out to customers 1 or 2 days after the due date. You don't want to be annoying. You don't want to be the irritating person in business, but you want to make sure that you do this politely, but that you make sure you get paid. People often ask me whether they should pursue people who aren't paying them if there's a serious delinquency. Well, you can. You can send a formal letter. You want to make sure that you just say that this is being done for the purpose of collection. You can consider legal action, including small claims court. I have one client who insists upon going to small claims court whenever they're not paid. But be aware that there are expenses involved, both out-of-pocket expenses as well as your time. So I would suggest that before you do any of that, you check on the ability of the debtor to pay. Be prepared to cut price and collect what you can before you proceed. And don't be afraid to fire a customer. If people are not paying you and they're consistently not paying you, don't continue to provide services to them until you straighten that out. You might also consider early payment and prepayment discounts for existing customers. I have a client who is in the in-ground irrigation system business. Every year in February, they send out a bill to their existing clients for the full year's basic service and offer a 5% discount for payment by the end of February. Valuable because it, to some extent, limits the accounts receivable. It also gets them cash in what is an otherwise slow period. So early payment and prepayment discounts have a place. Don't go crazy, because if you start offering 20, 25, 30% discounts, you're just not going to get a sufficient amount of money for the work that you're doing. You might also consider getting credit card authorization for regular customers and charge that card after the invoice is approved. But be careful, because if you get that information, you need to safeguard it. I would also tell you that if you're in a service business, landscaping, chimney cleaning, masonry, carpentry, there are plenty now of mobile payment apps that are very inexpensive that can communicate directly with your bank accounts. And you can then get credit card payments on the spot for the work that is done and avoid the hassle of accounts receivable. And if you're in a construction business, you ought to consider on bigger projects making sure that you get some kind of upfront payment and establish a payment schedule so that you're not going to be lying out of pocket significantly for things that you are buying in terms of supplies or work that you're generating. Now, a question has come in: is a line of credit with a bank preferable or 0% credit card? What is better for business, or should we try to obtain both? Well, I'm going to talk some about lines of credit. They are the best solution for working capital needs. What is a line of credit? Well, you go to a bank, and the bank agrees to advance you up to a certain amount of money as and when it's needed. You'll have to pay a commitment fee typically to that bank to get that, but it is available to you when you need it. And you will also, in addition to a commitment fee, you will have to pay that line back in full at some point in time during the year and leave it undrawn for 30 days. But a line of credit is absolutely a valuable tool to have for your business to support short-term liquidity needs. You may be in a business that is seasonal. A line of credit can help you to cover the slow months. In terms of a 0% credit card, that's, I assume you mean a credit card that doesn't charge you an annual fee. You're obviously going to the extent that the balances are outstanding for more than 30 days, you will be paying interest on the outstanding balances, and they will be hefty. My strong recommendation is that if you can get a line of credit, you get it. And if you can get a credit card, get it. Because those are two things that will be available to you to the extent that you run into cash flow shortfalls. And the more tools you have available in a small business, the better. Big businesses have lots of different levers that they can pull, but small businesses, you get trouble. Another question's come in. Inventory is due in 30 days and your customer pays in 90 or 120 days. Well, I'm going to talk some about that as we get later on in the presentation when I talk generally about working capital. So I'll table that question for the time being and come back to it later on. Some customers require 90-day payment terms. This is a deal breaker. No, it is not a deal breaker, but you have to factor that into your cash flow forecasts to make sure that you are only anticipating payments as you're actually going to be receiving them. And make sure that you can afford to do that in the context of the cash flow of your business. I mentioned before that I'd have other working capital tips for you. Just to slow down for a second, people will ask, what the heck is working capital? It's a fancy term for the excess or for current assets over current liabilities. So if you have more inventory, receivables, and cash than you do short-term payables, you have positive working capital. If you have less current assets, less cash, inventory, and receivables than amounts due in 30 to 60 days, then you have negative working capital. And negative working capital creates liquidity problems. So what do? Well, we talked some about the tips already, but avoid overbuying inventories, supplies, and equipment. Particularly in the retail business, so many clients that I have dealt with bought way more inventory than they actually needed. Now, I know that it's hard in a small business to not have a full line of things available to sell. And I know it's hard in a small business to count on people supplying you quickly if you might find yourself needing it. But if you end up with inventory sitting on a shelf, that's your cash. You paid for it, and you haven't gotten cash from selling it. So then what do? Well, if it's not selling, you need to simply think about discounting it, trying to move it, getting what cash you can, because it's tied up cash for your business. So avoid overbuying on inventories. Avoid overbuying equipment. Buy what you need, and only what you need, not what you might like to have. And any purchasing decision that you make should be made with the impact of your cash flow forecast in mind. Pay your accounts payable on time. And when we talked about having a 90-day period, for example, in certain accounts payable, or 30 days, well, don't pay early. I know everybody wants to be a good customer. You want to make sure that you have good relationships with your suppliers and your other vendors. But if they're giving you time, take it. Don't pay early. It's your money. Have it available to you in the event that something comes up that you need to deal with. But do not use tax withholdings or sales or meals tax payments as your cash. Those need to be turned over as promptly as possible when the time frame requires to the appropriate authorities. I've had clients who said, I have a minor cash flow hiccup. I'm going to dip into the withholdings that I've had and that I haven't turned over yet, and I'll be able to pay that back before they have to be paid. It's a bad practice. Sometimes that you don't get to a place where you can pay them back, and you can end up with very significant liabilities if you don't, in fact, pay those properly. So don't use those as your cash. Financing. What are the typical sources of financing available for a small business? Well, you have family and friends. That's a euphemistic phrase. It doesn't just mean your brother and your brother-in-law, your sister, your mother, or your uncle, or your aunt. It means the people in your immediate circle that you would be comfortable approaching for potential financial help in connection with the business activities. You'll have your personal savings and assets, whether those are retirement funds or otherwise. This is something that you need to think about carefully. Everybody has their own risk tolerance. You may be very comfortable putting a significant portion of your savings into a business. You may be very comfortable reaching into your retirement assets, but recognize that no business comes without risk. Not every business succeeds. And so you are taking a risk with those funds of your own and of your family and friends. So make sure that you understand that risk, that they understand that risk, and then you can make intelligent decisions about what risk tolerance you have and what you're prepared to do. I would also advise that you think about filing in the state of Massachusetts for a homestead exemption. That is something that is generally available to homeowners in Massachusetts. You file it with the relevant recorder of deeds in your locale, and it protects you against creditors reaching and taking your home up to a certain dollar amount value. I believe now it's $500,000, but I'm not sure. You can check that with simply a Google search. But it's a very smart thing to do to make sure that you protect that asset. We talked some about credit cards and the fact that if you have outstanding balances, the cost can be high, but they are very useful and very quick sources of credit in certain circumstances. We'll talk some about a bank loan availability, and you also have SBA financing. There are many SBA programs available to you. I'm not going to get into the extent of all of them. You could do a very simple search on the SCORE website or the SBA website to find out the sources available to you. SBA has a lender match function where you can go on their website, put in your information, and it will identify lenders that may be interested in financing your business. Equipment financing and leasing. Many times for small businesses, that may be the most readily available source of financing. Why? Because it's coming from somebody who's comfortable that they can do something with that equipment if they have to take it back. So don't be afraid to pursue that. You may be buying a business, in which case seller financing may be available to you. There are also online lenders. There's Kabbage, there's others. These are lenders that will take your application online. If they're prepared to fund, they will fund into your bank account. Be aware that these tend to be somewhat expensive, not just in terms of the interest rate, but in terms of the fees that get charged. But they can be an available source of funding for you. And people will sometimes talk about crowdfunding. Just be aware that crowdfunding is usually available only for very special circumstances, like it's a health issue or a very exciting cutting-edge business, and it requires a very significant amount of time and effort. So if you're depending on crowdfunding to fund your business, I think you're going to be finding yourself spending a lot of time to try to get it done and not a very high success rate. But it can be done. Just pausing for a second to see questions. Are there for-profit grants available for Massachusetts? There are many grant programs that are available for nonprofits and for profit-making entities. That requires research to look at what grant programs may be available. They may be available to help you to employ people. They may be available to educate some of your employees, training programs. Those are available and you can research them, but be aware that, again, like everything else, they take time and you need to write for grants. So it is not necessarily something that will come to you quite easily, but they can be achieved. Sorry, I'm just trying to make sure that I get the questions as they come through. So what do the bank look at? Well, bank financing can be difficult for new businesses. What will they look at? They'll look at collateral. What assets do you have available that might secure repayment? Can you get a mortgage on your business assets or your personal assets? Most banks will also require a personal guarantee. That means you're signing and promising personally to repay the loan. It's not necessarily that they want to make sure they can sue you, although they will if the payment is not made. They really are testing your confidence in your business prospects. Most small businesses will have to have some level of personal guarantee in addition to other collateral. The banks are also going to look at your character. What's your business experience? What is your business plan? Do you understand your business? Can you show that you will be able to be successful in the effort? And they will absolutely look at your personal credit. Many banks will have a level of your personal credit score that you have to achieve in order to be able to be considered. And many banks will require some level of history for your business, as opposed to loaning to startups. In my experience, the big money center banks are more difficult in terms of getting financing for a startup. But smaller banks, credit unions, community banks, on the Cape, places like Coastal Community Capital can be very valuable sources of credit. So if you're in the market trying to figure out what loans you can get to support your business efforts, those are the places that you'll be much more likely to be successful at. Banks will also think about the conditions. What are the state of the economy? What are the threats possibly coming in? What are the market conditions that are changing? Is there a big new competitor coming in? You know, if you're in a hardware store business, is there another Home Depot opening up down the road that may have a significant effect on your business? They'll look at the capacity of your business to repay. They'll do that looking at historical performance and also your cash flow. So they're going to want to see a cash flow statement from you and a forecast. And they'll want to see what level of equity you have in the business and what your reserves are. I would strongly recommend that you try to establish a banking relationship early on, even if you're not going to get a loan. Remember at the beginning, I said you were going to try to open up a separate bank account for your business. Well, when you do that, don't just go to the teller and get the documents. Try to meet with somebody who is a bank manager or a bank officer. Explain why you're opening the account. Tell them about the business you're getting into. And go and meet with them periodically, because you'll have much better opportunity to be successful at getting financing if you're not just walking in to cold call a bank asking for money. But if they have come to understand your business and how you're doing, you'll have a much better chance. Consider establishing merchant credit for supplies. When you're just starting out, that may be more difficult, but it's possible. And again, merchants are more ready to provide terms for you than necessarily a third-party financing will be. Consider working capital financing and work on getting a good track record for your future needs. Now, I'm going to come back to another couple of questions that were posed. Your inventory is due in 30 days and your customer pays in 90 or 120 days. What's the best way to approach this? Well, first off, you can try to get inventory longer payment terms. That may not be feasible, but you can try. In terms of providing your customer 90 to 120 days, well, again, if that's what you have to do because that's what the market demands, then that's what you have to do. But you need to factor that into your cash flow forecast. You need to make sure that if you pay for your inventory in 30 days, that your customer pays in 90 to 120 days, that your business has the liquidity to withstand that. You might also, in that circumstance, think about buying some of the inventory on a credit card and using that as a form of financing, or otherwise financing the acquisition of the inventory. It's very difficult when you have a mismatch between the due date of your payable and the due date for your customer's payment to you. So you need to bridge that gap in one way, shape, or form, whether that's other customers who pay more rapidly, whether it's other customers who will pay on delivery, whether it's getting a working capital line of credit to cover the mix, or using a credit card. When you're working business to business, the question is, should you check credit references? Well, you should absolutely make sure that the business that you're dealing with has a history of paying their bills on time. There are a number of ways to do that. You can check references. You can just check in the marketplace, talk to other people who have done business with them. Make sure that you are dealing with people who are going to be honoring their obligations to you. And yes, absolutely, companies are still doing that. Now, Venmo is a means to get payment. It's just like one of the online payments. You can get a credit card. You can get payment by Venmo. You can get payment by Zelle. Again, if you're in a business where you're providing a service, I strongly recommend that you use a mobile payment app. It gets you out of the collection problem. It gets you out of the unhappy customer who doesn't pay you problem. And it gets you to a position where you get your cash at the time. Yes, there will be fees associated with it, but that is a very valuable payment that you will make, because I can tell you the number of times that I have dealt with clients who have had significant accounts receivable problems, and it gets to be a real headache. The more that you can mitigate that issue, the better off you are. And again, if you have a customer who simply isn't paying you, don't keep doing business with them. You have to be prepared. I know this is anathema, but you have to be prepared to fire a customer. And don't simply allow, I know I have one client who's in the landscaping business, and he enters into contracts where he doesn't get paid for 60 days or 90 days, or gets paid at the end of the time period. Those contracts need to be recast. There is no reason why somebody should expect to get service delivered to them and not pay it on a monthly basis. And if you take on customers, you should, at the very beginning of the relationship, have conversation about how you're going to bill and when you expect to get paid. I would recommend in a small business that you make sure you get all of your customers' email addresses, because that is the easiest way to communicate. I had the residence that I used to occupy had a large lawn, and company had been servicing by mowing the lawn for years, and they went out of business. One of their employees started up his own small company and agreed to cut the lawn. But we sat down and he said, okay, here's what I'm going to do. I'm going to email you every month what the bill is. Do you want me to send it by email or regular mail? I said, send it by email. He said, okay. And I expect to be paid within 15 days because I'm running a small business. I'm not trying to be a hard guy, but I just want to make sure we have clear understanding up front. And that is absolutely the best thing that you can do in a service business. Either make sure you have clear understandings or get paid on the spot, with a mobile payment app. So I'm checking to see if there are other questions that have come in. If you have any other questions, fire away. If not, thanks for participating in today's program. I will, as I said, send out a link with the recording, and that should enable you to follow along again. Okay, I thought another question was coming in, but not. Thanks very much, everybody, and we'll look forward to seeing you next time around.